want to talk next. We have a lot of business owners that listen to the show. A lot of self-employed people. And, Arnie, you guys have done a great job. We actually had one of our agents who is a commissioned self-employed person get a loan with you guys and thought it went really smooth, much smoother than they expected it to go for being self-employed. What are some things self-employed borrowers need to do differently than a borrower that's got a normal paying job? Or what are some of the obstacles and things they really need to pay attention to set themselves up for success in the home buying and loan qualifying process?
Well, I would say first and foremost, you need to be open-minded about getting your tax returns to us. I mean, at the end of the day, any lender's going to want to make sure that you can repay the loan.
Right.
And some self-employed people have very creative CPAs.
Right.
And they do a great job of hiding real income. So,
and the challenge with that is that sometimes because they know they're doing, I don't want to give you my tax return. It's like, well, then you're not going to get a loan.
You're not going to get a loan.
Right.
Yeah. And not only the personal tax returns, but anything that ties into the personal tax, any business tax returns,
sure,
or corporate tax returns, all that needs to come into play. Why do we need your business tax returns? Because we want to make sure the business is still thriving if that's where your money's coming from. Okay. So here's one of the things that I think out in the marketplace that you're seeing some pain about is the self-employed guy who had a great year. Let's say we're in 2015 now. Okay, so let's say had a great year in 2013, not so great year in 2014. Okay, so that's what in the industry is called declining income.
Sure.
That happens with commission employees as well. Okay, and so what happens a lot of times is some lenders look at it and say, well, their income is on a downward slide, so we're not going to lend to them. Okay. But again, that's an overlay. We talk about overlays in all our shows where, basically it's an added guideline put on by many lenders. So what we do at Waterstone, for example, is we'll take your most current year's income and we'll average it over 12 months. Normally you average the income over 2 years, but if your income is declining, we'll take your last year and we'll average it over 12 months, and hopefully you can qualify for that, and that's how we get around that declining income issue.
Sure. And I think that's something that you run into a lot because salespeople income fluctuates, and or the other side of it is, and I think on the same token, let's say you have an amazing year this year, right, but then the last 2 years your income was a lot lower. They're going to look at that and say, oh, we got to average that. We're not going to just give you the qualification.
Yeah. So your expectations of buying need to be watered down a little bit because you're going to have to average that income, not just take what you made this year, because this year may not happen next year.
Right. And so also, and I think this is, like you said, the documentation of your income.
The documentation of the income, you got to get it in, and you got it in quickly. And I think as a lender, even if you want to hand over the phone number of your CPA and give the CPA authority to give us information, that's probably the easiest thing for you if you're a self-employed person. But getting that stuff in as soon as possible is just critical because that is going to make or break the loan.
And if you look at the ratios, self-employed person, obviously owner-occupant property and a single-family home are least risky. So the more, a condo or a rental property for a self-employed person, more risky. So
right,
those are the variables that the self-employed person is
layered risk in the lending world.
Yeah. And the borrower is going to be more likely to have to provide more documentation, or, the more risky it is. And they just have to understand that, you guys are going to verify everything, even from a standpoint of, hey, we need, a most recent income statement. We need your most recent bank statement. It's 2 days before closing. We got to confirm you're still self-employed. Is your business still operating? I know in the past when we had bought rental property, they'd called our office. Are we still in business? Yeah, we're still here.
Yeah.
But that's part of the process. You have to be prepared for that. Keep your cool, and just expect that there's going to be a lot more double checking to make sure that you are everything that you stated.
Right. Here's the other thing too: is that the higher the loan, the more important your credit score is. And I would just tell you that 417 is the ceiling for Fannie Mae and Freddie Mac. Anything above 417 is called in the lending world a jumbo loan or a non-conforming loan. If it's conforming, it conforms to Fannie Mae guidelines. And so whenever you get into that arena, now the gloves are off. All guidelines are depending on the particular lender.
Sure. Okay. There's no fed.
They're holding that loan. They're holding that loan.
It's their money.
It's their money. Yeah. So normally you need to have credit score. If you want the best opportunity is to have your credit score above 740. Then the next level down is above 700. Once you get below 700 in that arena, above 417, then your options are going to be limited. Now we can go down to 660, but if you're below 417, we can go down to 620 and maybe even 580. Okay.
Right.
But if you're at 660 and between 660 and 700, you're going to have a higher rate.
And self-employed.
And self-employed. Yeah. Right. Yep. Yeah. So that's a big deal. I wanted to talk, since we have our property manager here. Here's the other thing about second homes that maybe people don't realize is that a second home is in the lending world is a home that is a second home. You know, when you qualify, you have to qualify for the full payment. Okay.
Sure.
Right. But the actual definition of a second home is that you live in it 2 weeks out of the year.
Right. And it has to be a certain, doesn't have to be a certain distance.
It has to be a certain distance.
From
it has
your
to make
primary
sense. So if you're in Tampa and you want to buy a beach property on Clearwater Beach,
that you occasionally rent. Right.
That's a second home. But if you live in Clearwater and you want to buy a second home in Clearwater Beach,
not really a second home.
Not really a second.
Right.
Yeah.
Yeah. So that's and there are people out there that I'm sure attempt to kind of fudge this rule.